This short tutorial is going to look at the tax rules with respect to a CCPC's, Canadian Controlled Private Corporations, aggregate investment income. So let's start off with what is aggregate investment income. Now in your textbook, aggregate investment income is defined as the total of a corporation's net taxable capital gains for the year reduced by any net capital loss carryovers plus any income from property, specifically interest income, rental income, and royalties. Now the one thing to note is that aggregate investment income excludes dividends that are deductible in computing taxable income. So essentially any Canadian source dividend income are not included in this definition of aggregate investment income. Now these rules apply just to CCPCs, to Canadian controlled private corporations. Let's take a look at these facts here. We're going to consider two scenarios, and this is going to help us understand why there's special rules with respect to a CCPC's aggregate investment income. We have $100,000 of aggregate investment income, and in the first scenario, we're going to assume that that's earned directly by an individual. In the second scenario, we're going to assume that that individual sets up a corporation, specifically a CCPC. The CCPC is going to earn the $100,000 of aggregate investment income, and then the CCPC will distribute a dividend to the individual shareholder. We're going to assume an individual 45% combined federal and provincial income tax rate for an individual, and for a corporation, a 38% combined corporate tax rate. So let's look at scenario number one. The individual earns $100,000 of aggregate investment income. They're going to pay 45% tax, which is $45,000. So after tax, the individual will have $55,000 of cash left over. Let's go down and look at scenario two. Scenario two, the CCPC earns the $100,000 of aggregate investment income. And remember we said that a CCPC pays 38% tax. Then once again, this is an assumption, so let's assume that that CCPC has a 38% tax rate. They're going to pay $38,000 tax, and so they're going to have $62,000 left over. Well, now, if we look at these two amounts of taxes, there's an incentive for the individual to set up a CCPC and maybe buy a bunch of shares, and then within the CCPC earn aggregate investment income, maybe taxable capital gains, interest income, rental income, and there could be a deferral because the corporation, the CCPC, will pay a less amount of tax, and so they're going to defer tax at the individual level until a dividend is paid to the shareholder. So what the government says is that we have to come up with special rules to remove this incentive. So what are these special rules? Well, the corporation will still have to pay the regular Part 1 tax at the assumed rate of 38%, but there's going to be this additional Part 1 tax, this ART, this additional refundable Part 1 tax, which is going to be calculated as 10 2/3% times the lesser of the CCPC's aggregate investment income or the taxable income of the CCPC minus the small business deduction. Well, let's assume for this simple example that the lesser of the two amounts is the $100,000 of aggregate investment income. So $100,000 times the 10 2/3%, that's going to add an additional $10,667 to the Part 1 tax. The Part 1 tax will now include the $38,000 and this additional $10,667. So the total Part 1 tax paid will be $48,667. So then that's going to remove the incentive from setting up a CCPC and having the CCPC earn the aggregate investment income. Because remember, at the top here, the individual will pay $45,000 individual tax. The CCPC will now pay $48,667. So that deferral opportunity is completely gone. And in a sense, the CCPC will pay more tax up front than if the aggregate investment income was earned directly by the individual. Now, that's the first part of this scenario. The second part is, well, when the corporation ends up paying a dividend to the individual shareholder will have to pay individual tax. So that seems kind of unfair, because overall the corporation is going to pay this huge amount of tax, $48,667, in the year they earn the aggregate investment income. But when the CCPC pays a dividend to the shareholder, the individual shareholder will have to pay another layer of individual tax. So that seems kind of unfair. So the government came up with the rule that says that, yes, we're going to make the corporation pay this huge amount of tax, but part of that will be refundable when the corporation pays a dividend to their individual shareholder. So then we have to calculate, well, what amount of this $48,667 is refundable? Well, the refundable part is the lesser of three amounts. 33 2/3% times the aggregate investment income. Once again, aggregate investment income in this example was $100,000. And so that's going to be $30,667. Lesser of that amount, 30 2/3% times the taxable income minus the small business deduction. Now, let's assume that the lesser of these two amounts is the $100,000. So we're going to assume that for the first two amounts that we're both going to end up with $30,667. And then the third amount is the Part 1 tax payable. Well, the Part 1 tax payable, once again up here, is the $48,667. So the lesser then of all these three amounts is going to be $30,667. Now, if the CCPC ends up paying a dividend to the individual shareholder, the most that they can get back is $30,667. But that amount will not be refunded until the CCPC pays a dividend. So in order to track all these refundable taxes, the CCPC then is going to have to set up an RDTOH account. RDTOH stands for Refundable Dividend Tax on Hand. So included in the RDTOH account, we're going to add this $30,667 in the RDTOH account. So the CCPC will keep track of all the refundable taxes, and eventually when they pay a dividend to the individual shareholder, the most they can get back is $30,667. So then let's talk about if they end up paying a dividend to the shareholder. If they end up paying a dividend to their shareholder, they're going to get what's called a dividend refund. That's the amount of refundable taxes the corporation is going to get back when the corporation distributes or pay a dividend to the individual shareholder. Now, the dividend refund is going to be the lesser of the balance in the RDTOH account, this $30,667, and 38 1/3% times the dividends paid. So let's just take a look at this example then. Let's say that in the next year, the corporation distributes a dividend of $80,000 to the shareholder. So in the next year, the corporation is going to distribute or pay a dividend of $80,000 to the individual shareholder. Let's see how much of a dividend refund they're going to get. Well, the RDTOH balance is $30,667. Now it's the lesser of that amount, and 38 1/3% times the dividend paid. The dividend paid was $80,000. So we take 30 1/3% times 80,000. We're going to get 30,667. So what this is saying is that in order for the CCPC to get back all of those extra taxes that they paid up front, they're going to have to pay a minimum dividend of $80,000. The amount that they get back is known as a dividend refund. And so once again, these are the special rules that relate just to a CCPC's aggregate investment income. So that brings us to the end of this short tutorial. Good luck with your studies.